could think about, well, what happens if the central bank targets the exchange rate? This is a policy that has been followed and it still is followed by many countries. Like Denmark, for example, in Europe, as part of the European Union, it has its own currency, the Danish crown, but the central bank of Denmark follows a fixed exchange rate policy with the European central bank with the euro. So there's a fixed exchange rate between the crown and the euro. Right? So the central bank in Denmark doesn't control its nominal interest rate independently. Why not? Right? It moves its interest rate in order to ensure that the exchange rate is always some constant. Right? So if the ECB, let's see if the ECB raises its interest rate, right, that would shift up this curve here, then Denmark has to raise its interest rate if it wants to maintain the same exchange rate, which is declared as its policy. Okay, and this is of course, you know, that many countries have done this all around the world for thousands of years, right? So under fixed exchange rates, we have you can have a country, a central bank operating either under an explicit exchange rate target. So in Denmark, it could be perhaps implicit. You know? There's maybe not you know, an announced exchange rate, but the central bank is following that exchange. There are many countries that have an implicit exchange rate target with, say, the US dollar, particularly because that's, you know, the currency used in many trading markets around the world. Right? And we've already talked a little bit why this might be useful. If you have business that's conducted, trading business abroad that's conducted in terms of the dollar, and your central bank ensures that, so think about this, if the central bank in Vietnam kept the dong US dollar exchange rate constant, then it wouldn't be an issue if you conducted your business in dollar or in dong, right? Because that exchange rate risk is gone. Right? What's the cost? I just mentioned it. Then the Vietnamese central bank wouldn't have control of its interest rate anymore, not independent control. It would have to engage in policies changing its interest rate following American monetary policy to maintain the exchange rate. Right? Right? So we would gain a constant exchange rate, but we would lose the ability to conduct monetary policy in Vietnam for Vietnam. We would just be following US monetary policy. Okay. So there's a trade-off there. So it's not clear that fixing the exchange rate is necessarily a good thing. Right? There are benefits, but there are costs. Sometimes we have countries that do more like a floating, like a crawling peg. Like we know there are reasons perhaps, right, due to like, you know, different growth rates and the like, that our currency should be appreciating slowly over time instead of doing, you know, an appreciation overnight. Right? Let's say that there's reason to believe that maybe the let's say Bhutan Ngulien should appreciate 100% relative to the dollar. If you did that overnight, that would be a very, very disastrous policy, a very large change. You would have many companies that had contracts in one currency or the other that had huge losses. Sometimes it's a lot better than, well, we need to appreciate, let's not do it all at once, let's do it slowly. Let's have a crawling peg. Right, we want to match the US dollar, but we need to appreciate, so let's match the US dollar from now, and let's just slowly close that gap over time, or crawling peg, for example. Right, okay. So this quick loss in competitiveness was what I was mentioning before. Okay. There's experience from this in the European Union. In the 70s, the end of the 90s, when the euro was introduced. And just to see the danger of this, we had a exchange rate, a system of exchange rates in Europe. It was sort of in this tied to the German Deutsche Mark. And then there was a change in the economic system. Germany got a lot larger suddenly in 1990 when the former East Germany unified with West Germany. This is like, a change to be like a reason, like I said, Bhutan maybe sees that it needs to depreciate 100% or 50%, right? Suddenly the size of the German economy changed, right? And the old exchange rates were problematic. So a lot of countries then decided to left, or to leave, to change, or they wanted to change the exchange rate. And some countries, for a while, tried to maintain the agreed upon exchange rates. A good example, so you can see that the dangers of this. Sweden also a member of this exchange rate system. Trying to maintain the fixed agreed upon exchange rate with the Deutsche Mark. So we saw our interest rate parity. There's a change, and there it's just the German I star, but you can think of economic systems and other fundamental factors that would change it. And they tried to defend, to maintain this agreed upon exchange rate, and in order to defend it, so some currency speculators are saying, they're going to give up the exchange rate, which means I think the kroner is going to go up, so I'm going to buy kroner now, right? And so you have currency speculators coming in, and to try and defend these the exchange rate, to push back against the speculators, the Swedish Central Bank raised nominal interest rates, and then to keep raising nominal interest rates, and then to keep raising nominal interest rates up to 500%. 500%. This is from the Swedish Central Bank themselves, and this is cut out of the newspaper. This is the entire front page of the newspaper. That's incredible. Imagine if to take out a loan as you're building a new factory, the interest rate that you need to pay is not a 10% interest rate, which is pretty high. It's not a 20% interest rate. It's not even a 100% interest rate. You don't double the money over the course of a year. A 500% interest rate. That's, we think about here just our ISLM, the consequence of I going up that high, what happens to investment? That's a huge, huge shock to the economy. Right? So, this is not even, sometimes people talk about exchange rate risks and exchange rate fixing, exchange rate policies and monetary policy as maybe a problem of the past of say, emerging economies. But that's not true. We see this was a big problem. Just for example, even in Sweden in the past 30-some years. Yeah? Okay. Right, and you can then go a step further. For now, to solidify, right, the European exchange rate system has been fixed. And it's been fixed so strongly that, like, there's a, this is a German coin. That's, right, and it's a €2 coin. Right? This would be 5 or 4 Deutsche Mark. Yeah? We now have a fixed exchange rate of about 2 Deutsche Mark per euro. And it's so fixed that we just have the euro. Yeah? And a euro coin from Germany, you can use to pay in euros in France. Right? So a currency union is simply like the most extreme case of a fixed exchange rate. It's fixed so strongly that you don't even have an independent currency anymore. All right, so we can start to see how this would work. So let's take our interest rate parity condition, and let's fix the exchange rate. So now and in the future, we're going to keep this exchange rate. It's going to be E bar. This implies here immediately that our interest rate has to be equal to the foreign interest rate. All right, so there's now no ability, right, to cause exchange rate movements, right, to think of interest rate differentials, or in other words, there won't be any, to maintain the exchange rate, right? If the United States, let's say let's fix our currency to the US dollar, and the Federal Reserve lowers its interest rate, that would tend to make, and we keep our interest rate constant, that, as we just talked through, that would make our currency more attractive. People want to buy Vietnamese bonds, right, to take advantage now of the higher interest rates in Vietnam than in the United States. So what would they try to do? They would try to sell their dollars for dong to buy bonds here in Vietnam. Right, so buying the dong would then, lots of people buying the dong, that would tend to push the exchange rate up. Right? It would cause an appreciation in the dong. But no, we have a fixed exchange rate policy. We've committed to keeping a constant exchange rate. So we cannot permit, right, the exchange rate to rise. We cannot permit these large-scale purchases of dong with the US dollar. How can we stop that? Well, what's causing people to want to buy dong? Our higher exchange or interest rate. So we have to lower our interest rate to match the lowering of the interest rate in America. And now investors don't have an incentive, aren't going to try and buy dong to take advantage of an interest rate differential because there is none. But you see what happens right there. We lose control over domestic monetary policy. The United States might lower or raise its interest rate for reasons in the United States economy. Maybe there's a recession in America. Or what if there's not a recession here? You know? Maybe Donald Trump has some crazy ideas about what the central bank in America should be doing. Do we want our central bank to be following his crazy ideas? No? We lose control over our domestic monetary policy when we fix our exchange rate. So then, if we fix our exchange rate, we import the Federal Reserve and Donald Trump's ideas on monetary policy. Okay. Right, so if we look then here at the money market equation, right, in order to maintain this I star, right, so if I star goes up, right, which would cause an increase in money demand, we have to increase the money supply, right, to achieve that I equal to I star. Or goes, I'm sorry, negative. So if I star goes down, right, then we would need to increase the money supply here abroad. So right, expansionary monetary policy in the United States is going to cause us to increase the circulation of dollars in the economy. Right, so now we can see, for example, the effects of a fiscal expansion. Right, we have the IS curve gets shifted out. This is the increased fiscal expansion. Now this, on its own, we saw this would tend to lead to an increase in our nominal exchange rate. Which is what would cause right, an increase or decrease, in investment. Right? This would give us an interest rate differential. This would lead to an appreciation of our currency, which leads to a decrease in our net exports. But we have a fixed exchange rate policy. This decrease in the net exports because of an interest rate differential is what's going to cause people to try to buy lots of dong. They're going to try to take advantage of this investment opportunity with higher interest rates here in Vietnam, our central bank has a fixed exchange rate policy. So in order to maintain the old exchange rate, the central bank has to ensure that our interest rate stays the same as the foreign interest rate. So if we have an expansive fiscal policy, we have to follow this then with an expansive monetary policy, by exactly the amount to maintain a constant interest rate. This goes right to the question in the exercise. Wait a sec, you remember the first lecture, the beginning of the first lecture, we saw the first multiplier, the government expenditure multiplier? We did derive that, an increase in G, right, under the assumption that investment, the interest rate stayed constant. This increase from A to C is the original full complete multiplier. Okay? The multiplier right, has its entire effect here because we have this automatic joint response by monetary policy. Right? It's maintaining a constant interest rate in the face of this increase in demand through government fiscal expansion. Okay. So let's look now . I saw that I had a picture of my camera last night in my room. There was a lizard that came in my room. So the thing is, so in Germany there aren't any dangerous animals, right? So you get there aren't. It's really, but there are where I come from. So I grew up with venomous, poisonous spiders that lived in our house. There are rattlesnakes where I come from. So these poisonous, like these rattles, they go. Right? So there are mountain lions, which are like a puma. I don't know if it's like a cat about this big, right? So it's like a little tiger, right? Bears, right? So dangerous animals. And so then whenever I go to a foreign country, like I'm always like, so, I don't know what the dangerous animals are here. It's a lizard, right? Is this a dangerous lizard? Right? Right? There's some countries, right, that little insects can be really poisonous, right? In some countries, there's a little octopus. Yeah. In Australia, it's like this big, right? You know, the blue-ringed octopus. They can kill you. So, so at first it's like, oh no, there's a lizard. I don't know what it is in my room. Is it dangerous? So that's the cool thing though with the technology now. I took a picture and I could use Google Lens to identify it.
Google Lens.
Yeah, I did, and Google Lens told me it is a. So you're gonna laugh. That's good.
Có sao rồi sao anh? Ngồi trong đó sao rồi?
So let's see if the Google Translate can do its job. You can understand. So listen.
Anh là nhà công trường.
No?
No, just no.
So it was then I was okay. That's not dangerous. That's okay. So I was fine. But the first thing, you see an animal like, oh, I don't know what this animal is. Is it a friend or is it not a friend? So that's why I just saw that the picture there. Okay.
Chị nhớ là chị nhớ con chị là con chị nó cũng thích thằng lằn lắm. Thằng lằn kia.
So here, explain how shifts in the exchange rate affect the net exports component of aggregate demand. So we're supposed to explain. So I have in the short run,
thầy chưa có lịch cho thầy nhắc rồi đó, hay lý tại sao đi tới đây
with
không chỉ là sao đi tới đây học này
fixed prices, and our Keynesian assumption, we have that the real exchange rate is equal to the nominal exchange rate,
chỉ cần là thầy thích phải nói cái đó
which also means
nói chung là quanh tuần
our exchanges are equal. So, increase in the exchange rate means that
cái khúc phía đầu nó bụi vậy đó xong cái này nó bụi
have a real appreciation
sao nó chia ra vậy
and
tại sao nó chia ra vậy nó
one
lùng
unit of our good or our goods basket and command
nó dài vậy nó dài nó dài
more of the foreign good than before.
anh nói cái e
This makes foreign goods less expensive for us so our demand for them imports increase. Right, this also means that our goods are more expensive for foreigners so their demand for our goods our exports decreases. Right, and then we can last little icing on the cake part, although this appreciation means that the goods we import cost less per unit. There's the price effect. Marshall Lerner condition tells us that the quantity described above dominates so overall increase in the exchange rate means a decrease in net exports. Okay. And this just just while we're there, I think it's the concept of this real exchange rate. So the nominal exchange rate is, I think, pretty intuitive. We all deal with that all the time. And this, so if our currency appreciates, this means, right, we get more of a foreign currency for our currency, right? And this doesn't seem to a real appreciation means we get more foreign goods for our goods. How can we think of this like without thinking through money? Right? There's sort of like, there's a sense, what does this mean? Like our goods are then like, they're not as good in quality. So like, with 1 kilogram of American rice, you can get 10 kilograms of Vietnamese rice. This like, why American rice that much? This doesn't make. What's going on? How can we think about this intuitively? And I like to think about the real exchange rate. Like think about like the hours of labor that go into something. Right. So think of like maybe the right price in labor hours, say, of transistor production. Alright, so if you think, so let's say that the price in labor hours per transistor here in Vietnam, it's in the past, was maybe 2 labor hours per transistor. Right, so essentially to produce a transistor, everything together was the equivalent of 2 hours of labor. Right? So it took 2 hours of work to make a transistor. And our competitors, Taiwan, it only took Taiwanese the equivalent of 1 hour of labor to produce a transistor. Remember all that.
Thế ví dụ Taiwan thì luôn mấy chị sao? Thì đây ví dụ nó giá không phải nổi tiền, mình giá là sức bao vị bao hơn. Thì mình nói nhưng mình sản xuất chừng 2 tiếng mới được một cái bán dẫn. Mà bên Đài Loan thì ví dụ hàng Đài Loan sản xuất bán dẫn.
We can if we write them TR star over PTR, we get 0.5, right? And this is in hours per transistor in Taiwan, hours per transistor in Vietnam, so 0.5 Vietnamese transistors per Taiwanese transistor. That would be our real exchange rate. So, no, the other way around. Two, and the units here are hours per transistor, hours per transistor star, so 2 Taiwanese transistor per Vietnamese transistor. So now part of Ho Chi Minh City, but formerly was it Dinh Duong province, went through a lot of development and expansion over the past 10 years, right? And these investments in development reduced the price of producing a transistor to 1/10 of an hour. Right, so 6 minutes. New factories, new training, Vietnamese employees, equivalent of 6 minutes per transistor. Right? Okay. So what does this mean for this ratio here? PR squared. We have 0.1 over 1 hours transistor mu. That is 0.1 Taiwanese transistor, Vietnamese transistor mu for now. So
Yeah.
you see here, right, it's a real depreciation. Right, so you think of what depreciation in terms of the nominal currency is when our dong loses value. Yeah? Right, so our dong is cheaper. Depreciation, dong is cheaper. And then we think, okay, if the dong is cheaper, this means that our goods are cheaper. Right? So we're more competitive. Well, the other way that we can, and the reason why we think of this competitiveness, we think of this sales as transaction, if we think of this in terms of competitiveness of the economy, not competitiveness of the currency, we get the same result here. Production of transistors have become more competitive in the former Binduang, no. What did it used to be called? Binduang?
Bình Dương.
Binduang. Yeah, no
Yeah.
chance, no chance. So Binduang, the tonality's gonna kill me.
Yeah. Just bin is fine. Yeah,
Bin
you
Duong.
you is like year, you.
Yeah.
Yeah.
Whew. Right, so we achieve competitiveness, an increase in competitiveness, an increase in competitiveness through a decrease in our real exchange rate. Right? What does this mean? The decrease in the real exchange rate means essentially the Vietnamese transistor before was expensive. Right? You'd have to give up in terms of the cost, the real cost, 2 Taiwanese transistors to get 1 Vietnamese transistor. We're saying nothing about the Vietnamese transistor or Taiwanese transistor being better in terms of quality. It's all here about the unit labor costs. And we are now able to produce them more competitively in Binh Duong.
That's fine.
That's fine, yeah. Right, so this means we have a real depreciation, a decrease in the real exchange rate, which means that's right now you have to give up less than 1 Vietnamese transistor. If you give up 1 Vietnamese transistor, the labor cost for 1 Vietnamese Taiwanese transistor is equal to the cost of 10 Vietnamese transistors. Right? So this decrease in the real exchange rate, right, is the cost measured in terms of our transistors of a foreign transistor. So it's now become cheaper in terms of labor hour. Right, yeah, so that's what we think, that's what we say, like, you know, when the real exchange rate goes down, right, when the non-exchange rate goes down, this means we get real depreciation, we get fewer, less foreign currency for our dong, or foreigners get more dong for their currency. In terms of real exchange rate, we get fewer goods in trade from abroad for exchange of our good, and foreigners get more of our goods in exchange for their goods. And it's not saying something about the quality of our goods, right? It's reflecting the competitiveness here. We can think here about the cost of production. Right? people getting more of our goods in exchange for one of their goods, you could say is, it's not, oh, American rice is better because to get 1 kilogram of American rice, you need to give up 10 kilograms of Vietnamese rice. This makes it sound like the American rice must be fantastic. But what we're really saying is that Vietnamese are better, are more efficient, are more competitive at producing rice, right? Whereas for the same, labor, with the same inputs, Vietnam is able to produce 10 kilograms of rice, whereas America, with the same resources, is only able to produce 1 kilogram of rice. Yes, it's not talking about the quality, it's talking about the effort that has to go behind it. So essentially, others getting more of our goods for 1 unit of our good simply means it's really expensive, they're really inefficient at producing these goods relative to us. Yeah? Okay. So let's look at essentially finishing. The adjustment here. Right, so we're going to argue the results of the lecture under the flexible exchange rate are incomplete. Let's examine the effects, including the impact of real exchange rate, or the impact of exchange rate adjustments, an expansionary monetary shock, and an expansionary fiscal shock. Think of this. So to expansionary Y S zero, zero, interest. Okay, let's look at an expansionary monetary policy shock. Which curve moves? I've got 3 curves here. We have an expansionary monetary policy shock. Which one is going to be moving here?
Shock LM.
The LM curve, yeah. And is it going to be moving to the left or to the right? To the right, exactly. The reason that we can say that it's to the right is that it would mean for everything else being constant, so including output, this means we'd be lowering the nominal interest rate. That's expansionary monetary policy. Okay. So this would be increase in money supply. Okay. So our interest rate falls below the world interest rate. Right? People are trying to divest from our country to move to the abroad where we have the higher interest rate. Right? So they're selling the dong to buy other currencies to take advantage of the higher interest rates elsewhere. So we have a real depreciation. Useful to remind ourselves of this. Let's write that here. Our IS equation, y is c, y minus t, positive, plus I negative. There might be other components here. We're just going to n plus g plus nx, and then y star e because we have the constant prices. Okay, well, with a decrease in the exchange rate, we would tend to see, what does this mean? We have a depreciation. Imports become more expensive for us. Exports become cheaper. Right? We sell more exports and we import less. This would be an increase in net exports. This would tend to give us then
Increase in net export. Yes.
our net exports would increase. We'd still have this exchange rate effect up until the point so we might expect with floating exchange rates that expansionary monetary policy ends up having a very large effect on output, right, but no effect on the exchange rate or the interest rate. Right? Why? As soon as there's imagine just a little tiny bit of the expansionary policy starts to hit the markets, right? So the first $100 million, the first $1 billion would hit the market. This would tend, right, to start to lower the nominal interest rate a little bit. Right? This lowering of the nominal interest rate would start to depreciate our currency. That the dong is losing the value, we're producing more. As our exchange rate then starts to fall just a little bit, right? There's some companies that before, I don't know, am I gonna buy my transistors from Taiwan or am I gonna buy them from Vietnam? Oh, the price for me in dollars for transistors in Vietnam has just gone down a little bit because the exchange rate's gone down a little bit. Now it's cheaper for me to buy from Vietnam than Taiwan. I'm gonna buy Vietnamese transistors. Our net exports start to rise just a little bit. So as this expansionary monetary policy unfolds more and more, the whole time while it's unfolding, we see net exports increasing along the way. So we'd expect in the end a movement along here, and we keep moving to the right until we get to this point here. At this point, right, the monetary policy shock stops. Right? There's no more further expansion, right? And so then the expansion of net exports stops. So in some sense here, because we have trade, we have any exchange rate differential is going to lead to a movement in real goods here. It's going to move to an adjustment in the net exports. I mean, so like for me, when I come here to Vietnam, I look at the exchange rate, and then I start to think, wow, has it gone up? Has it gone down? Does this mean it's a good time for me to buy things while I'm here, or is it a bad time? Look at prices. I do this in little. The big companies are doing this in big. And so even a small little difference in exchange rates, right, can make a large difference in our decisions, right, to purchase an economy. Right. So we end up not having any movement in the exchange rate. We just get a large shift in our net exports.
Professor, so the interest rate period to will come back to the I0 again?
Yes, so the idea is to think, I've done it here, 0, 1, and 2, that first we have this, then we have that. But it seems, I think in the end, what I was trying to say is we would probably never see the interest rate go down.
So E2.
We've been moving across just to the right with this red arrow. So if you think of, the idea is not, don't do the whole monetary expansion at once. Start with just that first little step. And as this, so think of, while we're going all the way up there, we first have to start with this little movement here. And so as we start to go down here, we're then instantly going to have, well, a slight lowering in the exchange rate, which will lead to a slight increase in net exports. So we probably just see a movement horizontally. Does that answer your question, or did I interrupt you before you got to your question?
I think you answered it in a different way.
Oh, okay.
Yeah, but I mean, so the interest rate will go back to it when it was before, right? Okay.
Yeah. Or again, if we think of this as like a continuous process, it would probably never depart from this. Right? Here we have maybe the exchange rate falls and comes back. Well, I was trying to draw this arrow here. Probably what happens if this happens bit by bit, it wouldn't change. There'd be just small little movements, and as soon as there's a little movement, right, you're going to take a big advantage of it.
Can I ask, normally when we come to shock, we usually categorize into temporary shock and permanent shock, right?
Yeah.
So what kind of shock is this one?
This is permanent. We're not looking at what happens when we move back, right?
Okay.
Yeah. Okay, now an expansionary fiscal shock. B. Interest rate parity. Okay, now we have expansionary fiscal policy. So that's going to be which curve moving?
Fiscal bias.
The IS. To the right or to the left?
to
To the right. Exactly. So we have now our good morning. Okay. All right, so IS shifts out to the right. It's going to push interest rates expansion. So Y goes up. This is going to be partially crowded out right, by it's debt finance. The government's crowding out public investment. Public borrowing is going to crowd out private investment. The interest rate goes up. It's increasing the interest rate. Right? It's a good time to invest in Vietnam. So investors are going to sell their currency and buy dong so they can invest in in Vietnam with a higher interest rate. That's going to drive the exchange rate up. Right? We're going to have a real appreciation. Everybody's trying to buy dong. Right? So you then end up having to give up more foreign currency for the dong, right? Or the dong, you get, for the dong, more foreign currency for the dong. So nominal exchange rate here goes up. Yeah. You get more foreign currency for the dong, or for the dong, you get fewer, less foreign currency. Okay, so what does this mean in terms of our net exports? Well, if the exchange rate has gone up, we have a real appreciation. This means that we foreigners have to give up more of their currency to buy the dong. We fit it up with the investment. This makes Vietnamese goods expensive for them. Exports are going to go down. And for us, we get more foreign currency for our dong. Goods from abroad are going to be cheaper, so our imports are going to go up. Both of these are going to, together, do what to net exports? They're going to reduce net exports. And we just saw, right, so the IS curve, right, we're changing something on the IS curve. It's not an I or a Y, so it's going to be a shift.
Yeah.
So on here, it's going to the net exports is going to shift the IS curve, and with the exchange rate having gone down, this shifted the net export curve out. Right, with an increase in net exports. Here, we have an increase in the exchange rate, so that's going to push net exports down. And it's going to push them down. They'll be
Tính ra là ta đã gửi email rồi, giờ anh Minh làm một chạc vậy tao
Email cho bên scholarship.
ý là tao muốn làm cho nó tao quan tâm nữa, ý là tao chỉ học bài thôi á, xong giờ tao thấy hối hận quá.
Sao vậy?
Ý là bạn sẽ có cái gì đó sau cái đoạn chat này update không?
Nghe được email sẽ ok hơn.
This is very discouraging. This tells us that government expansion has no effect. You know? Remember, like in the first exercise, we talked about like a changing in the distribution over time. That's all we have here. You know? So before we saw like in the long run, right? A government would just displace either private investment or consumption. Here all we see is that the government wants to increase its consumption. What it's going to do is just reduce net exports by the same amount. Okay? Right? Because what happens is the government tries to spend more and more. It's pushing up, each time it pushes the interest rate up a little bit, and this would tend to push the exchange rate up. Right? This makes our goods less expensive. Right? So our exports go down and our imports go down. And as the government spends more and more, all it does each little time, it just raises the interest rates a little bit again, right, before they go back down. Exchange rates up a little bit, and each time then net exports go down by a little bit. So we end up not having, if we do this like in a continuous way, it wouldn't be shift out and then back, but we would just never leave that initial equilibrium point. You have a question?
Because I saw that in Vietnam, the economy mix both together.
Mm-hmm.
Yeah, we saw this morning. We talk about the money supply,
Okay. Yeah.
more money to the economy,
Yeah.
and beside that, they also expand the government spending on infrastructure around. So
Yeah,
that
yeah.
is one way of the G increase.
Yeah.
Yeah. So they mix the policy together.
Yeah, so
Yeah. So the direction of is it means that they want to control the interest rate here, because each of them have the opposite direction for the interest rate, right? So
with the different policies. Yeah.
So it will mix the policy, so the interest rate will not. They want to control the interest rate, not let them fluctuate and easy, right?
So I mean, so when we start to apply this into the real, to think about there might also be a difference between different types of goods that are produced. So government expenditure, right? Building roads, right? If this reduces net exports, this might reduce our our exports of something else. We don't export roads, right? So it's not like the roads. So Vietnam is now the government is then building the roads that we would have otherwise export, right? When we start to look into the details, it can be a little bit more different. So this might make sense in that there are some non-tradable goods, right, that we want to have here, right? Public investment. This is going to have the effect, if it's debt financed, that it would tend to displace then maybe some other goods. So, right, by building roads here, we make our exports of T-shirts less competitive, right? So then the idea would be that the cost, right, the payment for these new roads is then paid for by the exporters of T-shirts in the end. And if you combine these two policies, well, what you see is that if the fiscal policy by itself has no effect, the only policy that's having an effect, if you do expansionary monetary and expansionary fiscal policy, is simply the expansionary fiscal policy. But on the other hand, you could say, what happens here? You then now have these roads that are being built, not paid for by the T-shirt exporters, because the expansionary monetary policy makes the T-shirts competitive again. Right? The expansion of roads is being paid for by an increase in the money supply. Maybe there's some inflationary consequences in the longer run of that. Right? But here we end up not having any interest rate movements.
Yeah, that about the theory, but to make sure that haven't any moving, so we need the data to explain it better.
So we're looking, so if you're looking at a specific, right, this just gives us the broad strokes, right? That's always then, it's a suite of models. It's like Google Maps, right? You're zooming out, zooming in, right? So now, when you're starting to look at a specific policy, right, then you have to think about, it's not just, here we just have a good, there's the basket of goods. And the government usually doesn't just buy the standard Vietnamese basket of goods, it's buying specific goods, like streets. Right? And in our basket of goods that we spend money on, right, we indirectly, I guess, we all spend money on streets, but that's the government isn't buying the basket of all the goods, they're just buying streets in that example. And also our exports, we also, and when you look in the details, we don't export the same basket of goods that we ourselves consume. So there's going to be distribution effects, right? There's, I think,
Distribution.
right? So if you look at Vietnam exports a lot more textiles and transistors, for example, as a proportion of the exports than we have in our own consumption baskets in Vietnam, right? So the composition of the export basket of goods is different than our domestic consumption basket of goods. Here in this model, we've assumed it's the same thing. It's just the good. So we start looking at then it splits into a little bit more details perhaps. Okay, now let's look at these policies. These same policies, but let's do them under a fixed exchange rate. 3A. Again, M, S, interest rate parity, exchange rate, interest rate output, Y0, Y0, Z0. Okay, so now we have our expansionary monetary policy. Right, now this would tend to lead to a lowering of interest rates, which would lead to a lowering of the exchange rate. Now we have a fixed exchange rate policy. So what happens as the exchange rate starts to fall? This means with a real depreciation, which means, right, there's more dong per dollar, let's say. Right? So we're going to exchange, so it's more, no, the other way around. Right? It's fewer dollar per dong. That's the way we want to do the exchange rate. Yeah, fewer dollar per dong when the exchange rate goes down, we have a depreciation. The central bank can't allow that to happen. We have a fixed exchange rate. So in order to get, so we get more dollar for the dong, the central bank has to then appreciate the currency. Right? How do we appreciate the currency? We have to drive, so we're driving the price back up. Right? We have to buy dong. So we're increasing the money supply as a monetary policy, but to maintain the interest rate, to maintain the exchange rate, right, to maintain the interest rate, we then have to buy, the central bank buys dong with dollar. So we put more dong on the market, and then we buy it right back. Oh, under a fixed exchange rate, we lose, right, independence of monetary policy. Right? As I said, like, we have to follow the Federal Reserve. When Donald Trump says, does crazy things to the interest rates in America, when he says the Federal Reserve, he's trying to fire people there and tell them to do this and that, we import U.S. monetary policy. And here, this is what we see. We cannot conduct an independent monetary action, like increasing the money supply and keep the nominal interest rate, the exchange rate constant at the same time. So we've lost our ability to engage in expansionary monetary policy when we maintain a fixed exchange rate. Now, we have our expansionary fiscal policy. Because you see, right, this expansionary fiscal policy would tend to push the nominal interest rate up, which would tend to increase the exchange rate. We have a monetary policy of a fixed exchange rate. We cannot let the interest rate rise, which means we have to fight against this rising exchange rate, right, by bringing it back down. We have to depreciate our currency. To depreciate our currency, right, we'd have there would be more dong per dollar, or fewer dollar per dong. So we have to start buying dollars in the market. The central bank produces more dong and goes in the market and buys dollar with these newly printed dong. This is an increase in the money supply. Yeah? How much does it increase? Well, it keeps increasing until there's no more pressure on the exchange rate because we have a policy of a fixed exchange rate. Oh! So now in contrast to the case where we had flexible exchange rates, fiscal policy was ineffectual, it just led to a redistribution. Now, if we have a policy of fixed exchange rates, we get the full multiplier effect from government expenditure. And we can think intuitively back to policy mix. What we have in here, we have an automatic policy mix. The increase in G is followed by an instant increase in M to maintain the same interest rate so that we can maintain that fixed exchange rate. So we see under flexible exchange rates, monetary policy is powerful, fiscal policy less so. Under fixed exchange rates, monetary policy disappears as an independent policy, but now fiscal policy becomes very strong. Okay. Recall the fiscal multiplier results from the closed economy ISLM model. Compare the different multipliers. How important are financial markets in understanding the fiscal multiplier?
Professor, can we take a lunch break now and save that for the...
So I wasn't going to do it. I'm just going to just say because we've gone through this. Okay. We can just say this verbally, and you've got it on camera. So what have we seen? We saw in the goods market with interest rates constant, we get this multiplier. Right? This might be 10 let's say if we have a very high marginal propensity to consume, right? That's what we saw. So if marginal propensity to consume is 0.9, we can get a multiplier that's 10. Right? But this holds the interest rate constant. We take into account financial markets that the interest rate might have to go up as government is debt financing this government expenditures. Right? This would tend to reduce investments, which would reduce the size of this multiplier. Right? Now, in the open economy model, we see this multiplier, right, can disappear then completely. Right? Think back to the examples we had with the full adjustment because of expectations or prices. Now we can have the multiplier disappear completely because of an adjustment in the open economy. This increase in the nominal interest rate doesn't just reduce investment, it also drives up the exchange rate, which makes our goods less competitive, driving down net exports. This can be counteracted, right, if we have a policy of a fixed exchange rate, because then we have an automatic boost to the economy as the interest rate would start to rise from the debt financed government expenditures. In order to maintain the constant exchange rate, monetary policy automatically responds with an expansionary monetary policy, right, to keep the interest rate constant, and hence we end up having no negative effect on investment, no negative effect on net exports, and we get that full original multiplier again. So this tells us the fiscal multiplier can differ in an open economy from the closed economy, either by making the situation even worse, right? Instead of a reduced multiplier, we can get no multiplier, or we can fully restore the original multiplier. It's going to depend on how monetary policy is set up. Thank you very much. And now we'll take a lunch break. Okay?
Thank you very much for the